think we will get started. I want to just welcome everyone to the conversation today. We're excited to have with us Jordan, but I'll introduce Jordan Fishfeld in just a minute more properly. But I want to take just a minute now to thank everybody for joining us today, to introduce a little bit about the Crowdfund Professional Association. For those who may not be familiar with us, we are the national association for people who are professionals in the crowdfunding and crypto space. And today's discussion with Jordan is the perfect bridge to explain the connection between blockchain and investment crowdfunding. A lot of investment crowdfunding is done under Title II of the Jobs Act, which is primarily governed under Regulation D. And so Jordan's presentation, How Crypto and Blockchain Will Save Regulation D, is spot on, right in the center of our domain. And we're excited to hear from Jordan today. Jordan Fishfeld is the former CEO and co-founder of PeerRealty, which he sold, and current chairman of the board and co-founder of the CFX Markets and OpenFinance network. He's also, which is a secondary market platforms for traditionally crowdfunded and digital assets, respectively. In this role, he focuses his time on strategic planning and on general oversight in the new and growing digital marketplace. With over 8 years of compliance, legal, investing, and sales experience in regulated markets, Jordan understands the current the need for a single coherent voice in the crowdfunding and blockchain industries. Jordan is a frequent speaker on blockchain and crowdfunding and securities law topics, and sits as the editorial board chair of the blockchain and cryptocurrencies much of Financial Poise. Prior to founding PeerRealty, Jordan worked as finance attorney for Katten Muchin Rosenman, where he assisted on more than $1 billion worth of syndicated loan transactions. Additionally, Jordan sits on the board of Upstart, a national nonprofit tasked with bringing bold, new, and innovative Jewish ideas to light through its accelerator and mentorship program. Jordan received his Bachelor of Arts in Political Science and Bachelor of Science in Business Administration from the University of Florida, and his Master's of Business Administration and his Juris Doctorate from the University of Miami, where he graduated magna cum laude. Now, Jordan's going to make a brief presentation today. It'll take 10 or 15 minutes. We're excited to hear that. Following his presentation, I'll ask him a few questions, but I want you to know that if you're inside the Zoom app, click on the Q&A and you can submit questions that we'll have Jordan answer at the end of our time together. We'll try to wrap up at 1:30 in about 25 minutes. Jordan, take it away.
Perfect. Thanks so much for the introduction. It was one of the more complete ones I've had done on me in a long time. So appreciate that. Today my hope is to have a quick discussion on why I believe and why I think some others believe that the introduction of blockchain technology and specifically the security token market and the utility token market are what is needed to continue to jumpstart and probably reinvigorate is another great word to use here. The crowdfunding space, whether it be Reg D under Title II, Reg CF under Title III, or Reg A under Title IV. And so I threw in, I think, about 9.5 words there that are very much industry nomenclature. So, and Devin, kind of stop me or correct me if I'm wrong, but I think it probably makes a little bit of sense to jump into some of the basics on what are Title II, III, and IV quickly, and then why I think blockchain is going to kind of kickstart that space again. And so really, we'll assume that there's at least a basic understanding that crowdfunding is a fundraising mechanism that exists. And it was passed, as we've all kind of heard about, under the Jobs Act. And the three big components to it were Titles 2, 3, and 4. Title 2 allowed for public solicitation under traditional Reg D offerings, which just means private security, but you can advertise. Reg CF under Title 3 allowed for public solicitation to non-accredited investors with very, very tight rules around how much you can invest, who can invest, and some of the disclosure requirements therein. And Title 4, also really powerful tool, and I think probably one of the most powerful tools as it relates to what I see blockchain supporting is Reg A, and specifically Reg A Plus under Title 4. This again allows for public solicitation of investors. Those can be non-accredited investors, as long as certain disclosure and information rights are allowed. And there are a lot more detailed and nuanced rules in there, but it's not worth giving a legal lecture in 10 minutes. So I'll avoid that and just go with the big parts of it. And so we back in 2012, 20 to 2014 or so, the crowdfunding industry was really excited about this opportunity to publicly solicit investor funds. I as kind of as an investor advocate and sitting on the Crowdfunding Professional Association board, found this to be a really unique investment tool for new, younger, high net worth investors. And so rather than needing, 100,000 to 250,000 and putting that into a single private placement deal, this new mechanism was going to allow for much better diversification in the private markets. And so that got me very excited. And I started a company to do just that, specifically around real estate. Tried to, ensure there was geographical, asset-based, and capital structure based diversity. So we had, equity positions in Minnesota, debt positions in Arizona. We had industrial properties to residential to commercial. And so really providing that opportunity to diversify. And we're still seeing some great companies do that. We sold it when we thought the time was right to focus on one of the new problems that came up, which was liquidity. We believe liquidity was an issue that the crowdfunding space didn't really expect to be as big of a problem for new investors as it became. And so I think what ended up happening is you had a lot of new investors making their first or very early in their private investment experience, and this kind of time horizon, which can sometimes be between 7 and 10 years, and their liquidity need unknowns really didn't match. And so the industry didn't get to take off like we thought it would because of this lack of in our opinion, and in some others, because of this lack of liquidity. There's also some comments on, certain deal flow and kind of found its way, and it's still a very young industry still. So I think we have some time, but to us, it was really about solving this problem for investors. And that is where I think blockchain comes in and really provides a significant new opportunity. And so if everybody's familiar with blockchain, it's basically a technology that allows for a decentralized databasing system that has kind of a very, so the useful tools for us, and instead of going into a blockchain lecture as well, is its record keeping capabilities and its transaction speed and efficiency, both from a cost perspective and from a actual documentation perspective. And so when you looked at the problems around transferring private securities, and we built a whole business around this, it was very analog, very time consuming, and administratively unbelievably burdensome, both for the sponsor, for the third party broker, for the transitioning buyer and sellers. And so it's the price ended up reflecting that friction, and it was almost a non-starter for most investors. And so now you had investors who weren't necessarily comfortable investing in the time horizon without any access to liquidity, but the liquidity solution was extremely burdensome. And so between those two, we kind of had this plateau stall in the growth of the crowdfunding space. And then, you know, Bitcoin and the crypto market had its bull run, its large bull run from, call it 2016 through the end of 2017. And there was a lot more innovation in the technology and a lot more application of the technology to new industry. And the transfer of private securities became one really exciting space for the application of this new technology of blockchain. And I, you know, while there is Bitcoin and Ethereum, and they're fantastic coins and really exciting securities to gamble in, I'll say, because there's not another way to say that other than gambling, fun gambling. The underlying technology allowed for a great solution and transferring of information, in this case, who owns what. And so that's kind of where we are right now in the world of development, is creating trading platforms that allow for tokenized assets to transfer amongst users far more efficiently, far more effectively, and with an administrative cost that's actually reasonable. And so what I'd like to kind of dive into is why, in more detail, is why will this affect crowdfunding, and why is it not just something that crypto is going to enjoy, right? So what we've seen, you know, call it 2017 with the launch of a lot of the ICOs, I would say strong estimate, 90% of the token sales that occurred in 2017 were done so without any regulatory oversight or infrastructure. So not under Title II, III, or IV. Basically under in my opinion, faulty assumption that a lot of these were not securities, but instead utility tokens, which means it had a non-security function that allowed it to be sold just like a product or a license or a ticket to a show. You don't need a securities right to sell tickets, but you know, that was a little bit of an aggressive, in my opinion, stance taken by a lot of these companies. And so we saw, you know, the SEC kind of respond to that very quickly with Jay Clayton's kind of comments on his view of utility token sales changing the market sentiment. And that's when, for me, it got really exciting. Now, this is what we're seeing now, is this kind of new and invigorated market of security token offerings, STOs, which are regulated sales of securities under one of the three regulatory structures. But the underlying asset, rather than it being a paper certificate, which is ridiculous, or even a non-certificated interest that's documented in a schedule on an LLC operating agreement, we now have them digitized and securitized using the token format. Some of them benefiting from unique token economics, but using that technology to evidence ownership. And this is, from a crowdfunding perspective, I think such a key solution for the growth of crowdfunding. And I define crowdfunding as non-institutional sales of security interest in amounts that an everyday investor can participate without concentrating their portfolio. So kind of a multi-part definition there for me for crowdfunding, but the basic idea is small investors can get into a large number of deals without over concentrating their portfolio in any individual asset class in any individual deal. And so this makes that possible. You now have an administratively light product. So when I buy a token, it's sent to me. Dividends and distributions are sent through technology, through the smart contract infrastructure, down to token holders. And if I want to sell that token, there are some regulatory, kind of checks and balances here, but really I'm sending a token from wallet to wallet. And the smart contract, it just sends the new money to the new token holder because it follows the token and not the individual person. So that was one of the big problems that we always had on our trading platform was, when there were dividends and distributions coming, who owned what, when, and what if the check was sent to the wrong person, and how do you claw that back? All of those issues disappear when you're dealing with a token. And so it really becomes exciting from, an efficiency standpoint. Now, we had to close basically every quarter, close the books on the quarter when we were doing transfers. And so you could buy it the first day of the quarter, but you wouldn't actually affect ownership until the end of the quarter to ensure that no distributions were made. That's just not necessary anymore. And so now you can get better pricing. You can actually have, as somebody who desires liquidity fast, which is generally the sellers that we experience, you no longer have to wait, call it sometimes 12, sometimes 16 weeks. You can actually get your funds within 5 to 7 days. And so with this addition to the space, our expectation and my expectation is, and we're seeing it already with the growth in the security token market, but that more individuals will feel more comfortable investing in local businesses, industries that they're comfortable with, cash flowing assets that they want to include in their portfolio, because if and when a liquidity need strikes, they will be able to access that in some fashion that's not just unbelievably burdensome. And then from the sponsor's point of view, and I know I'm running up on time here, from the sponsor's point of view, they can actually support that liquidity because it's not crushingly burdensome to them either. They don't have to deal with changing all of the information on their cap table, ensuring that checks are going to the right place, the liability that a check does go to the wrong place and they signed an acknowledgement that they wouldn't do that, but they did anyways, and now they owe twice the distribution from what they thought they would. So, it just, they weren't incentivized to help before because it just caused problems. Now it can actually be beneficial and there's no real cost to them. So I expect very much as kind of crypto winter thaws and the market is now moving in the right direction and more innovation and more capital is coming to the space, we'll see the growth in crowdfunded by blockchain really take over the space. And so that's kind of, the overarching thesis that I think we're going to see. And the kind of presentation is, as a sponsor or the goal is as a sponsor or as an investor, I think looking for those opportunities and participating in those opportunities is a great way to continue the growth of the crowdfunding space, which I believe is necessary to closing the wealth gap in the United States. So that's my presentation. I think I hit it right on time, actually. You're on mute.
Thanks for calling my attention to the mute. By the way, we're live on Facebook. So although, so we've got a good audience here on Zoom, we also have more people watching us live on Facebook. So we've got a great audience participating today. And we'll also have this available as a recording on Facebook and on the Crowdfunding Professionals Association website in perpetuity via YouTube. So this will be a resource for everybody for a long time. What are the economics of issuing a new token, a security token? Jordan, can you walk us through a little bit of that from the issuer standpoint?
Yeah, so from an issuer's perspective, there are kind of two parts to issuing the token, right? You have the kind of traditional legal and regulatory cost of doing any type of security offering. And that will probably be marginally more expensive now that you're doing a token because you have to pay a lawyer who's comfortable with tokens. Most of them will kind of just say, no, I don't do that because there's no value in their opinion, which I disagree with. But so you'll probably but not a significant amount that should be cost prohibitive. And then the second part of it is actually developing the technology around your security token. Fortunately, there are 5 or 6 firms that just do that. That's their job. They have, I think there's one on Stellar, there's one on Ethereum. I think they're building one on Bitcoin subchain, if I'm not mistaken. And so EOS. And so you have, these firms that will basically white label a side chain on top of one of these public chains for you to issue your token. And from a cost perspective there, it really depends on a lot of things. Are you US and international or both? How many tokens are you trying to mint? What type of economics within the token structure are you looking to code? And so, it can range from anywhere. And again, these prices are fairly mobile given the nascency of the industry. But it could be anywhere from 5 to 50,000 if depending on what you're looking for. That to me is probably a cost that will start to be commoditized pretty soon and start to decrease and kind of set itself towards the same amount that it would cost to rent Carta for cap table management or some other, technology system. So it's now probably more expensive than it should be, but we'll soon, I think, find its equilibrium at the commodity type pricing level.
Yeah, very, very interesting. As you approach this from the standpoint of Reg D, but you highlighted at the outset the Reg D and Reg A both have ways for you to apply this technology. Tell us a little bit about the difference. I want you to walk us through the difference between Reg A plus especially, and Reg D, and how you see blockchain being used in each case.
Yeah, so I actually think Reg A is where this benefit will be most experienced in the medium term. And so, one of the great things about Reg A is the securities, because it's a mini IPO, the securities don't come with a lot of the transfer restrictions that a Reg D offering would have, right? So Reg D, from a regulatory perspective, are generally non-transferable for a certain period of time, be it 6 months or a year, depending on certain information points. But generally, Reg A are immediately tradable, and so the high-end fundraising capabilities of Reg A, around 50 million for what I would do, is a good number for a lot of these new companies. And so, while you can raise much more with Reg D, most don't. And so like that 50 million is a really good number. And then really what's great is, because they're regulated, because there's information distribution requirements and investor rights within the regulatory structure, and because they're tradable, trading platforms are going to be able to trade them far faster and far more efficiently than I think they will the Reg D. There's so much new development and coding that needs to go into trading a Reg D, by ensuring that non-US residents are the only participants for the first year under Reg S, by ensuring that you're not running into Investment Company Act issues under Investment Company Act 1940, which is a shareholder limit. So that's breaking apart your position into 1,000 different positions that could cause a problem for the underlying owner. And so there's just a lot with the Reg D that doesn't necessarily come into play under Reg A. And so as a result of that, I think Reg A has far more of an upside opportunity in using tokens as their cap table technology provider, if you will, and that OTC and other secondary market platforms feel far more comfortable trading Reg A securities because of the you're filing with the SEC before you launch. You have requirements for quarterly reporting and annual reporting, and all of those things make it just a much cleaner process for third-party trading platforms to participate. And therefore, if you have a platform like that, you have makers and takers coming to a central location, you should get better quality liquidity.
Excellent. This is great insights, Jordan. I've got one more question for you myself, but we'll have time for one or two questions, I think, after that from the audiences. So we've got people, again, watching on Facebook. I invite you to put questions in the comments there on Facebook. Those who are participating with Zoom, there is a Q&A button at the bottom of your screen. Click that to submit a question, and we will definitely try to get that in front of Jordan. But Jordan, I think a lot of people are reasonably scared of crypto after, I think you said it, 90% of the crypto offerings from 2017 failed. What makes new security tokens different from the 2017 cataclysm?
Yeah. And to be clear, the 90% of them they failed regulatorily in that they definitely violated some law. I would probably venture that's probably the right number that failed economically as well, but I don't have information on that. That's more anecdotal. What's different, in my opinion, is what that 2017 kind of excitement spawned a lot of opportunity for young entrepreneurs and experienced entrepreneurs to raise large sums of capital because it didn't cost anything to launch your token. It was very, very inexpensive to build your private chain. If you're a technologist, you can really do that, you and one other person. When you have to ensure compliance with a regulatory environment that you are unfamiliar with, you need to hire lawyers. Lawyers cost a little bit of money, or a lot of bit of money, I guess. But and that to me weeds out some of the more inexperienced and less capitalized opportunities. And what that does is and what I'm excited about is you're seeing companies that have raised money for 15, 20 years, let's say for real estate transactions using the traditional private placement mechanism, have always desired creating liquidity. And so they then say, well, this is a path for us. We know we're going to raise the money. It's not because we're a token that we're going to raise the money. It's because we have done this for 15 years, we're going to raise the money. And we're just documenting it through this new mechanism. And that's the mentality. If I'm looking at what is out there for purchase, to me, it's, are they raising money because they're a token, or are they raising money just using a token, but because they are who they are? And that's how I think, we're seeing that market gravitate towards that, quality transaction, be it, new companies that are probably Series B or beyond, who said, why are we, we're a forward thinking technology. Why are we using a cap table from 1927? Like, let's update ourselves there. And we can continue to do that. We're small enough now. We have 40 shareholders, maybe less. We can probably convert them all very easily and always have this beautiful token that represents an interest in our company, and may even go public with it, right? Once they hit the limits, they could even go public without actually having to list on a national exchange. They can have peer-to-peer transactions through the blockchain. So that's where I see it going, is not that security tokens themselves are going to change the quality, but because higher quality businesses are the ones able to navigate the regulatory environment, those are the ones that I hope and we're seeing take the opportunity to issue tokens to represent equity that most people would probably invest in anyways. It just happens to be evidenced by a token now.
Yeah. One of our Facebook viewers had a question for you. Richard Davidson asked kind of a foundational question. He said, I was told there were only a certain amount of total coins available and that were only a certain amount of coins. Why don't you address that misconception?
Yeah. So that's true of each individual minted coin, right? So Bitcoin, there are only 21 million Bitcoins that will ever exist in the world, in the history of the world. Now, that doesn't mean that you can't sell 1/billionth of a fraction of a Bitcoin, but there's only that limit. But if I'm starting a company and I want to name my token, Jordan token, I can mint my own token, and I can set in my original code in my mint code how many tokens I want to create. And so yes and no, I guess, is really the answer. Yes, there are a limited amount, and yes, you can code a limited amount into your initial block. But I can always just create a new side chain, new code. And that's what a lot of this, a lot happened. And the real question is, what does that coin represent? If you own one Bitcoin, you own one Bitcoin. If you own one Jordan coin, right now you own nothing, because I haven't really. And so that's really what it comes down to is recognizing what is kind of the basis for the value. And it doesn't have to be gold. It doesn't have to be a hard asset. It could be, monetary policy like we have in kind of the Bitcoin community, which is we all believe that it is a fantastic store of value and a future medium of exchange and an immutable record keeping mechanism for information dissemination and free information dissemination. So it really, that's kind of probably a little bit deeper, but that's the reality. Yeah.
Jordan, we're out of time, but we have one last question. This is a great question from Thel Woods. Please go through the conversion process, cash to token to transaction back to dollars. Does that make sense to you as a question, Thel or Jordan?
Yes. For a number of reasons, I think I can get to where Thel is going. So in the reality of buying a token, you're basically taking fiat, converting it into a token on some platform. And if I'm starting my own, call it coin, we'll stick with Jordan coin, more likely than not, I'm going to need to only accept some other coin. So you're actually converting fiat to ETH or Bitcoin or Monero or whatever, and then paying for my Jordan coin in that other coin. And then when I'm making distributions, I would be making distributions in Jordan coin. And if you wanted to convert that back to fiat, you'd have to go probably from fiat to Bitcoin, from Jordan to Bitcoin, or Jordan to ETH, or Jordan to Monero, and then one of those into US dollar on an exchange. So there's still some friction in getting from fiat through the system. And the real question becomes, at what point does fiat not become necessary, right? And so if I never need fiat because I can just convert, my shares of Jordan into Bitcoin, and Bitcoin is the method in which I purchase all of my products on any one of my online websites, do I really need US dollar? Do I really need euro? Probably not. And so then it eliminates a lot of that friction. But if you remember, Jordan coin is a representation of a share, whereas Bitcoin is a representation of money currency. And so those are, they happen to both be, coins, tokens, but they're very different. One is only as valuable as Jordan and the business make it to be, and one is as valuable kind of as the market and as monetary policy within the Bitcoin communities demand it be. And so, the real hope for, I think, a lot of the crypto enthusiasts is we won't really need to go back to fiat, that all of the, the volatility will start to slow down a little bit, and I can use Bitcoin or a lot of my other crypto as my main store of value and my main kind of use of funds when dealing in the online and digital world, and then maybe hopefully in real life.
All right. Well, Jordan, thank you very much for taking the time to be with us today. We want to encourage everyone to check out cfpa.org or the cfpassociation.org website, where you can learn more about the CFP, the Crowdfunding Professionals Association. And we'll catch you at our next Lunch and Learn with Scott McIntyre.
Perfect. Thanks so much.